So let's talk a little bit about what the markets are doing right now. So as we're speaking, they're continuing to fall, and the impact of that so far isn't very significant. The markets were so high priced that it's going to be a while before they get down to where they really are a bargain. They're still not a bargain. They're down, 10, 15%, pushing 20% in some aspects of the market, some of the indexes. And that means they're pushing into what's considered by Wall Street into a bad market. They call it a bear market territory, which means that it's pulled back 20% from its high. And what that does is it sends a message out to everybody to start to be afraid about what's going on in the stock market. And so you're going to, if this continues, see a lot of people get very concerned about their retirement. A lot of baby boomers will get very concerned about it. And as they get more concerned about it, they will ask for their money to be moved out and into something like a bond that's safer. And the impact of that will be, given the fact that so many people have bought indexes, that they have to sell these indexes in order to provide liquidity to the person that wants out of the market. And those indexes then go down. And when they go down, they trigger other selling. And this is what happens when you have no one seeking price. You basically have everyone in a huge percentage of the market just chasing the direction of the market. So the indexes were chasing the direction of the market as they went up, and people put more and more money in, and now they're going to start chasing the direction of the market as it goes down. And that is going to be really scary to a lot of baby boomers who simply don't have enough years left to have their portfolio go down 50% and still be okay in their retirement. So you're going to see a lot of shifting of capital out of this market, and you'll see the market accelerate if this fear starts to take hold. The market is conforming to what we'd expect in an event like this. We're seeing the greed has disappeared out of the market, and what has come in to replace it, of course, is fear. And as people become afraid, they start to move their assets, especially after the market's already down 30%. Now you'll start to see it really go. You'll start to see people moving their assets over to cash. And you're seeing that in the markets today, and it's confounding some people who don't understand the dynamics. We're seeing writing in the Wall Street Journal that is indicating that it's just really weird. People aren't even buying gold. They're just going to cash. And as a result, very short-term T-bill rates have dropped like a brick as billions of dollars have flown into the T-bill stuff. And so the rates of return in money market accounts are down to nearly zero now. And I imagine they're going to be near zero for a long time. And then the rates of long-term bonds started to go up. So now the spread has increased more in short-term to long-term stuff than it's been in a while. And this is all pretty much what you'd expect as the fear starts to dominate, that people aren't going to have the ability to stay retired if they continue to allow the market to decrease their wealth. And contributing to that, by the way, is the fact that the stock market has, I think in everybody's understanding, generated far higher returns than it should have. And we know from the Wilshire GDP that we were running at about 175% value of the market, price of the market to the gross revenue of America, and that's just way outlandish. It's over double what it's historically been on an average market. Average market being about 80% of GDP is what the market's priced at. So we would reasonably expect the market to correct back toward that figure until the Federal Reserve steps in and does stuff that causes people to feel very confident and start coming back into the market again. In a zero interest rate environment, which we're now in, it's very difficult to have yield anywhere but the stock market. And so as a result, people are kind of forced back in. And so the Federal Reserve right now is trying to figure out how to make that happen. They dropped interest rates to zero. They've just pumped $1 trillion out there, at least theoretically, in terms of liquidity on short-term liquid type of bank structures so that the banks themselves can have cash to get out to people's hands. And so we're starting to see the cash squeeze a little bit. One bank in this town just limited the cash outlay to you as an investor to $3,000. So that's an indication that cash is under large demand. And this is going to go on, I think, for a little while as the coronavirus has started to go through its doubling process over the last couple of weeks. The number of cases has doubled.
So what are we talking about here in terms of the Dow dropping 1,000 points? We're talking about restructuring my portfolio in order to accommodate the extra risk that the market could crumble. I want to be in a position, get this word, this is a key word here, of being anti-fragile. I don't want to withstand the market drop and, come out okay. What I want to do is if this market drops, I want to massively benefit from it. And so setting up a portfolio that's anti-fragile is exactly what we do in that 3-day workshop. We go through this for 3 days, and at the end of it, we produce a portfolio that's as close to anti-fragile as we know how to produce in real time right there that weekend. So that's what I want for you guys. We got 1,000-point drop on the Dow. Looks like the tech stocks are starting to sell off, people taking profit. Maybe it's a pause before the next launch and the market just keeps going like crazy. But there are some final stops that we're getting close to hitting. Right now, we are at a ratio of the value of the stock market, the price of the stock market, versus our sales in our country that we've never been at before. It's like insane where we're at right now in that ratio. About double where we should be, reasonably speaking. In other words, if the market came down by 50%, it would be properly priced. We're at over 30% on the Shiller, which is just historically insane. We've only been there 3 or 4 times in history. If you cut that in half, we'd be back to being normally priced. So there's a lot of signs out there screaming, not the least of which is Warren Buffett sitting massively in $140 billion of cash. That is the biggest screaming big red flag I've ever seen in my life. So pay attention out there, you guys.
You guys, if you enjoyed this video and you feel it was valuable in teaching you more about how to invest, hit the like button and please share the video with your friends. And if you want more investing content, subscribe to my channel. And don't forget to click the button on the screen. We got a free gift for you. Thanks again for watching.